Here's what Tom Lee says about small cap stocks. Now, here in this video, I will discuss what I believe is a big risk that could come to our markets this year. And the Wall Street is not even remotely thinking about this. This could be like your 2022 moment all over again. But you know, maybe a little bit worse. So we're going to talk about it here in this video. Hit that like button as well as subscribe to the channel. Let's get into it.
What about the broadening of the market? It's been slower than I think, than many, probably you as well, have expected. Why so?
I think that the broadening of the stock market requires equity inflows. I mean, we already know that for the entire month of January, retail investors were pulling money out of the stock market. Maybe they'll start to allocate in February, but the month that they did, which was December, we saw a spectacular move in the Russell 2000. Do I think retail investors are going to be taking money out of the stock market? And in fact, someone had showed me that margin debt now is down 20% from its highs. I mean, you know, if that's any signal to me, I think broadening is going to come really sharply, but it comes when retail begins to buy stocks.
I mean, I'm thinking to myself, though, why get inflows now? We really get inflows? I mean, I don't know. The next stop on the S&P 500 feels like it's 5,000. Tom, the time for inflows seems like it's past, and now maybe people are going to be reticent to move money out of, you know, money markets and whatever else into equities at these levels, no?
Yeah, Scott. I mean, it's of course, the risk reward was better in October, but nobody wanted to own stocks October 2022 or October 2023. But there's also a lot of research showing that buying stocks at new highs isn't a bad thing. I mean, look at NVIDIA, right? If someone would have sniffed at buying it at the new highs, then of course it's up another 40%. I do think you are correct that 5,000 as an important round number is a level we have to watch. I mean, if this is a strong market, 5,000 won't mean anything. But in February, 5,000 could be, you know, a short-term top before there's a big air pocket. I mean, that's a level to watch.
Yeah, remind us of what your targets are.
Our year end for S&P is 5,200, but given how strong January was and what it implies historically, because usually the full year plays out in the first month, you know, I think 5,200 is probably a little low. You know, it could be, yeah, much higher.
So you don't think the market's too expensive here, as some are suggesting?
You know, expensive is in the eye of the beholder. Excluding FANG, your investors are paying 15 times 2025 earnings. I don't think that's very demanding. So I feel comfortable buying the S&P and even small caps here. Small caps, as you know, haven't really participated, but they're hugely levered to Fed cuts and very, very sensitive to investor inflows. And so I think there's still a lot of juice in a lot of areas.
Our chart over here on X shares something that resonates pretty well with what Tom Lee just said. He says mega cap tech stocks are now outperforming small cap stocks by the largest margin since the absolute peak of the dot-com bubble. Now, why is this actually happening? Because if you look at money market funds with $6.2 trillion currently sitting in them, this is investable capital. Now, I think there's a big difference to differentiate between cash out there, just the money supply or money in people's bank accounts, and investable capital, because a small portion of people's actual, you know, overall amount of money is actually going to be investable capital, right? But this investable capital of $6.2 trillion is sizable. The fact that it's not in our markets is really not good, right? That's the reason why I believe small cap stocks have not done well. Now, what brings this money back into our markets? It's probably interest rate cuts. It's the economy doing better than expected. It's inflation falling more than expected. Now, I think ultimately, when this money comes back in, it's going to be a great time to be a small cap stock investor. It's going to be a great time to be an AMC stock investor as well. And I do think that's something that will at least start at some point in 2024. Now, with that being said, why large cap stocks have done well is because they're really not tied to interest rates. And theoretically, if we are entering into a recession at some point in 2024, which looks more unlikely now than it did before, but still certainly a possibility, you would want to be in your mega cap stocks. That is where you would want to be. You could make an argument that a recession might actually help out Magnificent Seven names besides maybe a Nvidia, via maybe less investment that would take place, and also an Apple, which less people would be able to buy iPhones. But for even Microsoft's concerns, for Google's concerns, I mean, that could actually, a recessionary environment could actually help those stocks. And that's why the money has pooled into those names. It's not necessarily that money has massively came out of our markets. Some has, obviously. There's been more outflows than inflows over the past couple of years. But what just happened is the money has moved from your average stock, from a stock like a PayPal or an AMC or a SoFi or a Palantir or a Fubo, into an Apple, a Microsoft, a Google, and Amazon. That money, once it comes back out of those names, that's when you get a larger, potential rally in your small and mid-cap stocks, something I am looking forward to over the next year or two. Now, also a little bit of concern here as well is your U.S. equity risk premium falls to a 23-year low. Now, what this means is basically if you have cash, right, or like the equivalent of a treasury, that's a lot more attractive than buying stocks right now. And you can see the U.S. equity risk premium is really calculated by the S&P 500 earnings yield minus the U.S. 3-month treasury bills. So your yield on S&P 500 earnings is not that great, okay? And your 10-year or your 3-month treasury yield, let's say if your yield is 2% almost on the S&P, around there, but your 10-year treasury is paying, or I'm so used to 10-year treasury, 3-month treasury is paying 5%, well, then you're upside down on your equity risk premium. And that, my friends, is a problem for stocks, at least in the short term. When you do get some bad news, it could turn bad news into really bad news at some point. Fun fact, 83% of Americans currently think it is a bad time to buy a house, according to Reventure. This is more than triple the 27% low seen in 2020. Obviously, not a fantastic time to buy a house, in my personal opinion. Now, look at the positioning. It's actually incredible. The rise that you have seen since the low of 2023 until now, you're at some of the highest levels of this is non-dealers in the U.S. index futures and in billions of dollars. So almost 170, 180 billion dollars leveraged long in upside futures in our markets, which is a pretty incredible amount. Now, if you do take a look at this one, this is also to Tom Lee's point as well. Garzarelli Capital says, as the Fed eases, we expect the Russell 2000 will be in a new bull market, as small companies have already refinanced, cut inventories, and reduced headcount. In late 1994, when the Fed suggested their tightening was ending, RUT gained 55% over the next 17 months. This falls right into the narrative that Tom Lee just went over, and I do think it is going to be a correct one. I do think at some point it will be accurate, but I do want to kind of outline what could eventually happen in 2024 by about June-ish, okay? So 2 possible outcomes. I think it's pretty clear in both of these outcomes, the U.S. economy is probably going to continue to do well. Right. I don't think we're going into recession. I think it's hard to make that call with just the sheer amount of jobs that we are adding and some of the economic indicators right now. If anything, you could be entering into an expansionary period for our economy, which is actually, pretty dang crazy to think about. Now, something else that could be a little bit of a problem. The question really is about inflation. If inflation does not continue to fall at really an aggressive pace, and the Fed is 100% sure that inflation is gone, then it's going to be a big problem. then you are not going to get rate cuts. There is a potential, and I'm going to say this right now, there is a potential that you do not get a single rate cut in all of 2024. Now, as markets are pricing in 5 rate cuts currently for 2024, if you start to not even look like you're going to get one, yeah, that is a huge problem. Reducing that from 6 to 5 or 7 to 6 to 5 like we have recently, not a huge deal, right? But to take that from 5 to 0 could be a problem. And that really just depends on if inflation continues to fall from now until like June or July-ish. But if it doesn't and we're not getting rate cuts by then, stocks could fall pretty big. Now, I compared this in the beginning of the video to 2022 because everyone during that time thought the Fed was going to raise rates by about 3 times, 75 basis points in 2022. The Fed ended up raising rates like the equivalent of almost 15 rate hikes, right? So we were caught off sides, and that's why stocks did very poorly. That could be happening as well to the other side now. Potentially just we're not going to get as many rate cuts as we think. And this can have big consequences for stocks, like I just said. Now, specifically with AMC and small cap stocks, they're going to be a lot more interest rate sensitive, a lot more prone to potentially doing well or doing poorly. If inflation continues to fall, let me know what you think down below in the comment section. Then we're going to be in a mighty fine spot by the end of 2024. If it does not, we're going to be in a big problem. If inflation continues to stay just sticky in this area, if you don't continue to see inflation falling, AMC stock could easily be in the 2s by the end of this year. If you do see inflation continue to fall and the Fed is able to cut rates 4 or 5 times, you could see a lot of inflows come into stocks like AMC, especially as your risk premium would start to rise. It would look more attractive to invest in stocks. Then I could theoretically see AMC stock at $10+ per share pretty conservatively, let alone by the end of 2024. Markets are going to be looking forward to hopefully an accelerating box office in 2025, and that should also be helping things out. Now, if this information also coincides with potentially Adam Aaron giving us a commitment to not diluting shareholders, or if something else materially changes during that time frame, for better or for worse, that can obviously affect the stock a lot. But I do think the risk reward still looks nice here. It still looks good. Could AMC fall a little bit more? Of course, but I think the potential upside could be a lot more than the potential downside. After all, AMC stock at $4 per share is lower than the lowest sell side analyst on AMC. And then the highest price target being $12 per share. $12 per share would be almost a 300% increase from here, and that would be pretty dang attractive. So let me know what you think about this down below in the comment section. I know me saying 0 rate cuts in 2024 is kind of off the walls right now when we still don't know what inflation is going to look like. But let me just be clear. The Fed's not going to cut rates if inflation is still 0.2% month over month. You need to see a couple months of 0.1% or 0% inflation on a month over month basis to get the Fed to actually start cutting rates, because 0.2% month over month is 2.4% on a 12-month annualized basis. That is still way too high. And Jerome Powell's been clear. As long as the economy is doing well, job market is doing well, people have jobs, economy's growing at what's estimated 4.2%. GDP for Q1, he's not going to be in a rush to cut rates, and he may not cut rates at all. And that is something I don't think stocks are prepared for right now. So maybe, getting the information as soon as possible could be, bullish for you. It could be that could help you make some money, maybe. Who knows? Maybe hedge out your portfolio. I don't know. I don't want to do anything too drastic. I don't want to run with this assumption until we get the next CPI report and really read into that, where the inflation is coming from. Is it coming from freight, Do we see an oil supply shock based on the conflict in the Middle East and what happened over this weekend with the new strikes? Does Iran get involved? How does that affect oil, things of that nature? So I really want to pick apart what the next inflation report looks like, and that'll help me come to a more reasonable conclusion of what's coming next for inflation. But really, the big story is all about inflation at this moment in time. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.